All right, hello, good morning, good evening, and good night. I hope you guys are doing absolutely fantastic because in today's video, we're going to be talking about 3 high yielding ETFs. High yielding being in the likes of about 6 to 10% or so. We're talking about the ETF High, we're talking about Buck, and we're also talking about CSHI. And the reason I was actually kind of prompted by a fellow member of our community, which is PS-PS60W, whatever your name is out there. I'm sure this is not your name unless you're Elon Musk's child. He or she said, can you make a video on high CSHI and Buck, please? Of course I can. And you know what? I decided to dedicate this video to you because that is what exactly I'll be doing. I'll be looking over these 3 funds. I'll kind of tell you a little bit about what they do. Even though I don't completely understand, I get a good sense of what they do. I'll tell you some things I like about each, some things I don't like about each, and then I'll give you some resources in order to really kind of further your understanding about these 3 ETFs. So if that all sounds good, please do remember to subscribe. We're up to 4,146 subscribers. Thank you to the 2 subscribers that joined us yesterday and today. So I want to say thank you. Without further ado, let's get into it. So these are all ETFs pretty much based around, we have High and Buck kind of placed around the $25 marker, and then we have CSHI about the $50 marker, which is about double that. Basically, you could see here by their stock charts, they all pretty much are flat, trend a little up, a little down, or pretty much all sideways. And basically, a lot of these 3 ETFs pretty much do a lot of the same thing. They do it in little different ways, but are around the same area, which kind of implies why they all have similar stock chart patterns. They all are in fixed income instruments, and they're all looking around treasury notes. If I can kind of pull up here, that's why I'm jumping screen to screen here. But High, for example, it deals with treasury bills, and I'm not super sure because they do say they write options. This video right here, I'll link this down below. This is a much better video that will kind of showcase exactly what the fund does, because I am personally no options expert, but I can offer my opinion on the subject, and that's what I'm here to do. But they pretty much all deal with treasury bills, whether they write call options on treasury bills or they follow it and they short treasury bills. I'm not exactly sure what each of them do. You could see here with CSHI, they go 1 to 3 month treasury bill. They're a 1 to 3 month treasury bill ETF. They do basically, funds seeks to distribute monthly income generated from investing in a portfolio of 1 to 3 month treasury bills and implementing a data-driven put option strategy. See, I'm not an expert in put option strategy, but I do understand what treasury bills are. Basically, they're investing in the future of the United States. It's something that you buy. It's kind of like a loan. I'm sure you guys also know, or even know more than me. But one thing that I like about this fund is that they do obviously have a decently high dividend that is going for all 3. We're looking at 5% with very minimal price movement. You're looking at 6% for CSHI. But one thing that is to keep in mind is their net expense ratios. You could see here a 0.51% ratio for High. For Buck, you have 35%. And then for NEOS, you have 0.38%. And when comparing this to something, for example, like SCHD, I really like SCHD a lot more just due to the fact it has a much smaller expense ratio. And anything you could really save on the expense ratio is going to help in the long term. Obviously, when you're looking at this, you're pretty much taking away from not only your dividend yield, but your overall return. You can see High has a little bit of a downtrend going here with that higher dividend. Maybe saying like, look, this strategy that all these ETFs are imposing, High, Buck, and CSHI, it looks like their maximum kind of payout could be about this 5 to 6%, because once you get into about 9%, you're getting into a little bit of capital depreciation there. So that's something to keep in mind, whether it'd be good to invest your money here and make 5%, or it'd be better to put in something like SCHD or an index like VOO, just due to the fact that you could potentially get 5 to 10% and not, 5%, 6%. You might get a couple more percent there. But there's not much more to be said. One thing that I would say is for CSHI that it's run by NEOS, and basically NEOS also runs SPYI, and we have a little bit more chart history with SPYI, and so that's why I kind of mentioned it here. 0.68% expense ratio, which is the highest among all these 3. So getting into our 4th year with SPYI, you can see that the stock price chart with a 10% dividend, you could have bought at certain times like $45 and been up decently on your money, but it has a tendency to fluctuate quite a little bit as it does kind of track the S&P 500. So this was just a short little video on 3 ETFs that were brought to my attention by one of the followers in our page, in our channel. And just to kind of show you, one thing to keep in mind as well is kind of their net assets too. High, it's okay. It's definitely a small cap ETF, but Buck, you're looking at a $80 million market cap ETF, which is very, very small. You could potentially say this is risky if you were going to put any kind of good chunk of money into it. It might be better just to put something. I keep recommending SCHD, and you know what? For a long-term hold, I think SCHD would most likely be the way to go with appreciation, and you're also getting a 3.5% dividend. Not that I'm necessarily knocking these ETFs, but I'm just thinking more long-term because I don't know how necessarily sustainable they are. Obviously, they deal with treasury notes, which are very sustainable. But when you're talking about maybe getting only a 5% return every single year, having an expense ratio that's decently high, that you could potentially just go something that's going to give you a little bit more capital appreciation, a little less dividend, but a little bit less expense ratio as well. So this was kind of my thoughts on these 3. I just totally deleted High, but you know what? It's all good. We're going to roll with it. I hope you guys did enjoy this video. If you guys did, please do remember to subscribe. We're up to 4,146 subscribers. And like Mr. PS60W, please do remember to comment, and anything that you guys want me to review, I'm totally more than glad. As you can see, we just lost a subscriber, so I'm so sad to see them go. It's very, bro, that's a little unfortunate, but you know what? I'm going to keep on rolling here. Anything that you guys want to see, please remember to just comment, and I will be sure to get back to you. So, all right, I hope you guys have a great day, and I hope to see you guys in the next video.